You know, there's that famous line from the Eagles song, Hotel California. I feel like everybody knows it.
Oh yeah, a classic. You can check out anytime you like.
But you can never leave. Exactly. And while, the song is about something metaphorical, it turns out it's a startlingly accurate description of the California tax code.
It's actually the perfect analogy. I mean, most people think moving out of California is just about renting a U-Haul.
Right, pack up the boxes and go.
But the Franchise Tax Board, the FTB, they have a totally different philosophy. Their view is, you can cross the state line, sure, but your wallet stays here.
And that's what we're calling the California exit trap. Today, we're doing a deep dive into exactly how that trap works, looking at audit manuals, notes from tax attorneys, and some, frankly, terrifying new ballot initiatives.
And this isn't a small issue. The numbers are staggering. We're seeing estimates of a $1 trillion reallocation of capital. That's trillion with a T.
$1 trillion. That's a historic wealth exodus, people voting with their feet.
They're fleeing to business-friendly states. You know the ones, Texas, Florida, Arizona. And that puts the state government in a total panic.
Mm-hmm.
$1 trillion walking out the door leaves a massive hole in the budget.
So what do?
Well, instead of trying to improve the service, they've launched this massive, quiet surge in residency audits. They are hunting people down, using data matching tools to find anyone who left behind what they call a sticky tie.
And the stakes are getting even higher. We're going to talk about the 2026 Billionaire Tax Act, and the legal mechanisms inside it could trap a lot more people than just billionaires.
It's a total paradigm shift. We're talking about taxing money you haven't even made yet. It's a fundamental change to the idea of property rights.
So consider this a survival guide. We're going to expose why the 6-month rule is a total myth and lay out the checklist for what they call a clean break.
You absolutely cannot halfway do it. That's where people get caught.
Okay, let's start with the biggest misconception. I hear it all the time. Someone says, oh, I'm moving to Nevada. I just have to spend 6 months and 1 day out of state and I'm safe.
Right. The 6-month rule. It feels logical. It sounds fair. If I'm gone more than half the year, I don't live there. But for the FTB, that rule is basically a myth for anyone really trying to leave.
Why is it a myth? I thought there was a rule about 546 days or something.
There is, but that safe harbor usually applies to people on, like, temporary work contracts. An engineer sent to Germany for 2 years. If you're a retiree moving to Scottsdale or a remote worker choosing Miami, that simple day count rule, well, it generally doesn't apply.
So the state isn't just looking at the calendar?
They are, but they're rigging the math. They use something called ledger analysis.
Okay, walk me through that. Ledger analysis sounds like accounting, but you make it sound like a weapon.
It kind of is. Let's take a hypothetical retiree. Let's call him Bob. He buys a house in Nevada. He spends 90 days there getting it set up. Then he spends 100 days back in California visiting his grandkids.
Okay, so that's 190 days. What about the rest of the year?
The rest of the year, Bob's traveling, a cruise, Europe, New York. He looks at his calendar and thinks, I was only in California for 100 days. I'm a Nevada resident.
Seems totally reasonable. He was gone for 265 days.
But in a ledger analysis, the FTB just throws out the travel days. They delete them from the equation.
Wait, really?
Yeah. They only compare the days you were in California versus the days you were in your new home state. So for Bob...
It's 100 days in California versus 90 in Nevada.
Exactly. The FTB says, you spent more time here, you're a California resident, and Bob owes California taxes on his entire year's income.
That is brutal. They penalize you for taking a vacation?
They penalize you for not establishing a new center of gravity. And this gets to the real legal trap. Domicile versus residence.
Which sound the same, but aren't.
Not in tax law. You can have 10 residences, but you only get one domicile. That's your true permanent home. And the state assumes your domicile is California until you prove otherwise. The burden of proof is entirely on you.
It's resident until proven non-resident.
And they decide that using the closest connection test, they basically weigh your life on a scale. And this is where we get into the sticky ties.
I love that term, sticky ties. Give us the big examples. What gets people caught?
Number one is your doctors.
Your doctors. Seriously.
Your dentist, your oncologist, even your vet. The FTB argues that if you really moved to Texas, you'd find a new dentist. You wouldn't fly back to LA for a checkup.
That seems incredibly intrusive. I mean, if finding a good doctor is hard.
They don't care. They care about your intent. Keeping the old doctor, in their eyes, proves you never really left. Another huge one is the family factor.
This is where one spouse moves, but the other stays behind for a bit.
Right. Say the husband moves to Florida to set up the new house, but the wife stays in San Francisco for 6 months so their daughter can finish high school.
Which is a completely normal family decision.
To a normal person, yes. To an auditor, it's a smoking gun. They'll claim that because the core family unit is still in California, the husband never actually changed his domicile.
So neither of them moved, in the state's eyes.
Correct. They both owe California taxes for the whole year. They're trying to plug a budget deficit, and you're the plug. And to find these ties, they've built what is essentially a surveillance apparatus.
Okay, let's talk about that. The surveillance state. This isn't just some guy looking at receipts.
No, it's forensic. They reconstruct your life. They pull cell phone records to look at tower pings. They want to know if your phone was pinging a tower in Santa Monica when you claimed you were in Austin.
Cell tower pings. That sounds like something the FBI does.
It is standard procedure for the FTB. They look at credit card swipes, Easy Pass toll data. They even look at the IP addresses from your online banking logins. If you paid your bills from a couch in San Diego, they know.
Wow. And I read about the Raghavan family case in the notes. This one just highlights the absurdity.
The Raghavan case is a perfect example. A family moves to Florida. Years later, the FTB comes after them. They demanded the usual stuff, but then they asked for a moving inventory list.
A what?
An inventory of what was inside their moving boxes.
You cannot be serious. Who keeps a list of every spoon and sock they pack?
Nobody. And the FTB knows it. It's a tactic. They want to see if you moved your near and dear items, like photo albums or family heirlooms.
So if I leave my high school yearbooks in my parents' attic, the state says I didn't really move?
They argue it's evidence you intend to return. But asking for an inventory years later, that is harassment designed to make you settle.
It's bullying. And we haven't even talked about real estate. I feel like that's another big trap.
Huge trap. A lot of people keep their California home, maybe rent it out. That's a bad move. If that house is available to you, the FTB counts it as a primary residence.
Even if I'm living in Texas full-time.
Yes. But there's a specific financial trap called the clawback that uses something called Form 3840.
Okay, unpack this. It's tied to the 1031 exchange, right?
Exactly. A 1031 lets you sell an investment property and roll the profit into a new one to defer capital gains tax. So you sell an LA building, use the money to buy a Texas building. You think you're good.
But you're not.
You have to file Form 3840 with California, basically telling them where that money went. Then, 10 years later, when you sell that Texas building,
They swoop in.
they swoop in and say, that original profit was generated in California, we want our cut. They claw the money back across state lines a decade later.
Unbelievable. It's financial captivity, and if this is what's happening now, the future looks even worse.
Which brings us to the 2026 Billionaire Tax Act.
It's framed as a tax on the super rich, but the mechanism is what's terrifying.
It's a radical shift. Historically, we tax income, money you earn. This proposal wants to tax wealth, specifically unrealized gains.
Explain unrealized gains.
Okay, you bought a house for $100,000. Today it's worth $1 million. You have a $900,000 gain on paper, but you don't have that cash unless you sell. It's phantom money.
It exists on Zillow, not in your bank account.
Precisely. Now, this proposal wants to tax you 5% of that paper gain every single year. If you're a tech founder, you'd have to sell off parts of your own company just to pay the tax.
It forces liquidation, and it has an exit tax component, right?
A nasty one. It targets people who try to leave. If you're a resident on January 1st, 2026, you are on the hook, and they're creating a wealth squad to enforce it.
Is this even constitutional? Taxing money that doesn't exist?
That's the big question. The Supreme Court recently had a chance to rule on this in a case called Moore v. United States.
And what did they say?
They punted. They issued a very narrow ruling and didn't answer the bigger question. So they left the door wide open for states like California to try this.
So it creates this massive incentive to get out now.
A use it or lose it mentality. Which brings us to the most important part. How do you actually do it? The clean break.
Let's get to the solution. What's the checklist?
You have to be absolutely ruthless. No halfway measures. Number 1, sell the house.
Don't rent it out.
Do not rent it. Do not keep it for vacations. Sell it. A sale deed is strong evidence. A lease is weak.
Okay, sell the house. What's next?
Number 2, move the money. Close your California bank accounts immediately. Open new ones in your new state. Don't pay for your Texas groceries with an old San Francisco bank account. It's a sticky tie.
It all builds the picture.
It's all about the picture. Number 3, the team swap. You have to fire your California accountant, doctor, dentist, hire new professionals in your new state immediately.
That's tough. You have relationships with those people.
You have to show your center of trust has moved. If you have a legal issue, do you call a guy in LA sticky tie?
Stark, but it makes sense. What's last?
Number 4, the paper trail. The very day you arrive in your new state, register to vote, get a driver's license, get a library card, join a gym. You are building a mountain of dated evidence that says, I live here now.
You're creating a dossier on yourself for the auditor.
Exactly. And one more warning, be careful where you move. If you move to a zero-tax state like Florida or Texas, the FTB is going to scrutinize you much harder. They assume it's for tax avoidance.
So moving to a low-tax state puts a bigger target on your back.
Your evidence needs to be bulletproof.
Man, so to recap, California is facing a fiscal crisis. They're aggressively auditing people who leave.
Correct.
The 6-month rule is a trap. It's about your domicile, not just days on a calendar.
And those sticky ties, doctors, clubs, family, are the hooks they use to pull you back in.
And this proposed wealth tax means the whole game might shift from taxing what you earn to taxing what you just own.
Which makes a clean break more urgent than ever. Sell the house, move the money, fire the team.
It really makes you think. Here's a provocative thought to leave you with. We think of ourselves as free citizens. But if the state can demand an inventory of your moving boxes, if they can track your cell phone pings to tax you after you've left, at what point does tax residency turn into financial captivity?
It's the ultimate question. Are you actually free to go? Or does the state believe they own a piece of your future forever?
Keep your receipts, watch out for those sticky ties, and stay free out there. Thanks for listening to The Deep Dive.